Hello, friends. Welcome back to another episode of Building at the Edges, a podcast from C Club. I'm your host, Jess, or that tall guy on the internet. And today it's my pleasure to bring you a conversation with Nick Grossman from Union Square Ventures. I've had the privilege of getting to know and work alongside Nick over the last number of years, and we're very proud to have Union Square Ventures as a strategic contributor in the C Club network for the last couple of years. And taken us so long to get Nick on the podcast. Definitely my fault, not his. USV is such a fascinating investment firm. They've been around since 2003 and have been early investors in consumer apps and been early investors in crypto. And so I thought we'd take the opportunity to dive into Nick's brain and understand the intersection there. I had a bunch of notes, so many questions I was going to get into with Nick, and I touched on basically none of them, which means that the conversation was truly engaging for me from the get-go, and I hope it will be for you as well. We talk about how USV creates their thesis. We talk about some of the early days, especially the early thesis and how it's evolved from there. We talk about crypto and the intersection of consumer and a whole bunch of other things. I really enjoyed this conversation. I know you will too. So we might as well just get into it. But before we do, two things. First, we host a weekly live stream at live.cclub.xyz. It's called Internet Explorers. And we dive into all the craziness that's happened in the consumer crypto space over the week and even beyond. It's been a lot of fun. It's myself, Josh, and our lovely VJ, Peace Node. If you haven't joined us yet, what are you waiting for? Get on over there. Fridays, 10 a.m. Pacific time, 1 p.m. Eastern, live.cclub.xyz. Love to see you there. Also, we're opening up applications for SCO7, our second consumer-focused cohort, our seventh cohort since the founding of C Club. Applications will open shortly. So I just want to put that on your radar. If you're building something in the consumer crypto space, we'd love to hear from you even before applications are open. You can find me on the internet at That Tall Guy. You can DM us through our C Club account, or you can also search and find Josh, who's leading that whole initiative for us. We love hearing about what you're building even before applications are opened. And so make sure you get yourself on our radar if you think we might be a good fit for helping you take your product to market. I think we probably are. Enough of that. Come hang out with us on Friday. Get ready for SCO7, and let's jump into this conversation with Nick Grossman from Union Square Ventures. Nick, welcome to the pod.
What's up, Jess? Good to be here.
I love how quickly we just get into this. We're like, it's like game on after a lovely little introduction chat. I'm curious how you introduce yourself these days, because I know there's like the clear, obvious way to introduce yourself, but you touch many other things.
Oh, man. Well, yeah, I guess we'll start with the obvious and let's see where it takes us. I'm Nick Grossman. I'm a partner at Union Square Ventures, venture capital firm based in New York City. We describe USV as a generalist investor who invests across many sectors. The way that we think about what we do is investing at the edges of large markets that are under transformative pressures. And we're looking for openings that are getting blown open by something in the world, whether that's a technology or a societal shift or, a climate shift. And we're looking for opportunities for startups to be able to follow those openings and push a rock downhill. But I guess the way to think about me personally is I'm an investor. I've been an investor at USV for about a dozen years. I didn't start that way. Didn't really think I would be an investor, if you asked me, even 10 years ago, while I was already working at an investment firm. But I was an operator at a startup for about 7 years before that. I got my start at this intersection of this dual interest between technology and cities. I worked in urban planning at the beginning of my career while I was also like building apps on the side as a freelancer. But I like, I like building stuff. I like being part of building stuff. I like thinking about the multiple layers of the things that we experience in the world, whether that's a place or an app or something we touch. And I like kind of peeling back the layers to understand how it was built. What are the conditions that made it possible? What is the infrastructure underneath it that enables it or makes it harder? I guess I'm an experience nerd that also became an infrastructure nerd. Maybe that's the simplest way to boil it down, because I've always been curious about the way that the infrastructure drives experience. So there we go. I didn't even know I would say that. Now I did.
I love this because, I feel very lucky to have you and the USV team as a partner in our C Club journey, and for like a number of reasons. But I think the one reason that I wasn't fully aware of is just like the deep competency and belief. Like you're talking about sort of participating at these edges, and there's like an infatuation at that specific piece that clearly Fred has, clearly you have, clearly all the other partners that I've met at USV have. And I think it leads to, it probably even out of the scope of this podcast, this really interesting culture that emerges there that, when you're around other CEOs of back, there is, I mean, I don't think family is the right word to use ever in like the discussion of business, really, but it's the closest thing I've seen there because there's, if you're for founders maybe who maybe at some point in the future have the pleasure of working with these guys, you're amongst people who you backed 2 or 3 times. They've probably been, many of them have been analysts before, or at least they've done something before. You steal them as an analyst for a little while before they go off and do something else. So like if people have this sort of view of what venture capital is, like the mean venture capital out there in the world, it is so clearly not what is part of the secret sauce. And it's not even secret sauce. It's just not the way that you as a group sort of show up in the world. And I know it's been, I've probably retold the story numerous times about various instances that have happened, either privately or in slightly more public spaces within the CEO or annual retreats that you guys do, where it's just like these little inflection points where like, holy shit, the level of belief and in that space and in the people that are behind here is like more than I even could have fathomed at that point.
Well, I appreciate hearing you say that, and there's a bunch in there. I think one of the weirdest things for me about working in venture capital investing is how long term it is. So, we raise 10-year funds. Those funds typically invest over a 15-year life cycle. We have 14 of them, stacked, overlapping. So we have like decades of committed attention, I guess, is one way of thinking about it in our work, which is something before getting into this, I never realized that one could have, because in the startup world, you're day to day, month to month, but in the venture world, it's really decades. And so I think that the two things that have enabled us to do that are so satisfying and fun to be part of are like being committed to ideas over a long period of time and committed to people over a long period of time. So the ideas piece is like this idea of investing at the edge. And maybe we could talk more about what we mean by that, but that's like an exceptionally consistent idea of USV across 20 years. But the people side is also incredible. Like I'm visualizing the CEO summit that you were at, earlier this year, where, yeah, you've got, I think there were 3 founders there who had taken companies public that we were investors in, and then had come back and started a new company that we're also now investors in. So now they're like seed stage or Series A stage founders, and they're all up in the mix. And they're people we've worked with for 15 years already, and we're going to work with for another 15 years. And then there are, yeah, as you mentioned, like a lot of the people who have come through our analyst program have gone on to build companies, like really big, interesting companies, some of which we've invested in, some of which we haven't. And we've sort of learned our lesson to pay closer attention when that happens and be part of it. But either way, I think we try to have we're a small firm. We're 20 people total. And Albert, I think at the CEO Summit this year, described us as sort of artisanal venture capital. I don't really know what that means, but it's a personal thing, and we like it that way, both within our team and with our broader community.
I think people would be shocked to know that your team's only 20 people, because there's billions of AUM associated here, right? And so I think that's like, yes, artisanal, but not small.
Yeah, that's true. But we have kept the individual funds small over the years. And so certainly they add up in terms of committed capital, and then they also add up in terms of like present value as things grow. But on a per fund basis, we started with a $125 million fund back in 2004 rather, as our that was the standard size for our early stage fund. It's grown kind of with inflation over the years. Our most recent early stage fund is 275. So it's larger, but it's not, orders of magnitude larger. It's not $1 billion. We're not doing $1 billion funds. And I think that was this is a before my time decision, but now I'm carrying the logic forward, which is you have to make a principled decision to keep the fund sizes small, especially if you have good performance along the way, because then there's interest. And I think the dynamics of running a fund really do change between a small fund and a big fund, both in terms of how you approach investing and participating in investment opportunities. and then how all of that has to track back to what does it take for a fund to perform well at a very small size, a medium size, and a large or extra large size. So we've really stuck with the small firm, small fund as much as possible, even though we're now 14 funds and 20 people. So we're sort of an institution, but we're like at the very, very, very small end of institutions.
Yeah, I can imagine. I think principled is the right word there, because the success that and track record that's been built up by the firm over the last little while could have led, like all the energy could have led to multiple $1 billion fund sizes here. And ultimately, I think that is where some of the fair criticism of VC really comes in, where it becomes this, fee business model. The incentives are about stacking fees rather than outcomes. And I think those decisions, especially around fund sizes, are huge. I mean, I think about the decisions that the C Club Ventures teams have made around that size. There was a lot more money that could have been brought into that vehicle, but going from 25 to 75, I think, is actually a meaningful group. I mean, especially if you get up into, the 100+ million, the check sizes that need to be bigger, the types of deals you need to go do are different. And it is a very different business to be run.
Yeah, exactly. And I, on the other hand, like, listen, to have the opportunity to raise larger funds on the basis of good performance is a blessing, and I don't, to be able to even be in that position in the first place is unbelievable. And I don't at all fault anybody for, building on successes and getting bigger at all. I think maybe the simplest way to think about why one of the reasons why we like to keep the things a little bit smaller is it just helps us fit into the deals we want to be in a little more easily. We're never in a position of trying to force a massive check into a small company because we have a lot of money that we need to deploy. We can be a little more nimble, a little more flexible. The other thing that we've stuck with as an idea is that with a very large fund, you tend to move more from a kind of a selective approach to a coverage approach. With a very large fund, you need to be in all of the things because you need many of them to hit in order to return the large fund. Whereas with a smaller fund model, we know that we don't have to be everywhere. We try to be where we want to be. If we miss something that turns out to be great, it's okay. We need a few things to be really great out of every fund for our model to work. And that approach is an approach that we really prefer.
So I want to get into some of the thesis setting, and there's a specific piece here that I think is very relevant to today that I want to get into. But there's something I have, like a draft tweet in my tweet drafts that I haven't shared because I felt like it's maybe too spicy to share, or at least I don't want to call people out, and that's maybe how I have it framed right now. But I'm curious. So there seems to be there's some other investors in the space that have been very vocal about how shitty crypto investors are. So I think that the thesis was, we hear from our founders, most crypto VCs are shit. They only want to get to token as soon as possible. Therefore, we're now just going to focus on or prioritize bringing in more degens into our world. And it just seems absolutely insane to me that would be the reality that people experience out in the world. Clearly, there are a lot of investors that are like that, but we have not found any the people who think long-term have not been a limiting factor right now. And then two, the degens to me are the sort of like more atomized representation of the worst aspects of some of like probably the worst crypto funds. So maybe to frame this in a more useful way, as you said, and maybe advise founders on how to think about building their cap table and how to go, what sort of investors they should prioritize. What's the recommendation you're giving there? Because I have very strong opinions on this as well.
Yeah, it's a great question. I mean, I think it really depends on what they're building and what kind of support they think they might want or need from investors. And it's also important to realize that there's lots of places to get support in a project besides investors. And so you don't need to solve every problem in the company with the cap table, just as a starting idea. But I think in the crypto space specifically, I kind of think about different kinds of capital. It's like short-term versus long-term. And then there's sort of varying levels of specific expertise that could help a project. If I'm reading between the lines here on the criticism of some of the crypto funds, I think maybe part of it is a little structural about liquidity and fund structure and kind of, more of a hedge fund approach to investing versus a venture capital approach to investing. I know there's lots of models out there that have different levels of, expectations on liquidity, and there's lots of ways to do deals in terms of lockups and vesting that can make things, make for more of a long-term structure, which I think you want. We often advise the portfolio companies that we're working with to work. Now, as a generalist, I mean, it's a little bit self-serving, but we like the idea of working with a generalist like us who has experience, decades building companies across many markets and maybe a holistic view of things, and also somebody who's more of a specialist on the crypto side who understands things about mechanism design and protocol design and, some of the mechanics of, the markets. And, there's just a lot to do here and a lot to figure out that I think having a real specialist on board who is fully in the weeds and can be there with you is very helpful. And I don't, I guess a question of like, do you get that more from the degen side or more from the crypto fund side? Probably both. But I just kind of think like long term is really important, and having, folks who are going to be with you through ups and downs and not just, ride the first wave up and cash out kind of thing.
I think it's very easy to dunk on VCs and crypto. And I love the fact, the fact that I was an early user of Twitter and so many of these Web2 tools and was unable to even get exposure to it or participate in it is like one of the core drivers of why we started C Club. But I think the more that I get into building, the more value I put on people that are that are structurally able to be a part of the journey for a long term. So if you're saying, we started off this conversation, the 10-year funds, 15-year sort of operating commitments, that is so meaningfully different than where all the incentives for, tokens and liquidity and many investors that are there. And so I think to me, that's the important point here. And, we're thinking about constructing a cap table. The strategy you've outlined here is very much one I ascribe to, but doing so and trying to find these folks who are going to have a history of being there for the long term, and those people exist in pure strategic crypto funds too. There are people who are, they're the ones who have been loud for this last year and have been continuing to push things forward.
I guess there's another piece to that though, which is you also just can't ignore the fact that there is liquidity sooner in this space, which is an important characteristic of the space. And it's part of what makes it open and accessible. It's part of what helps protocols grow. And so obviously there's a lot of kind of negative implications of that, but there are also some positive implications of that. And so I wouldn't want the only takeaway from this being like everybody should hold forever, because from an investor's point of view, the fact that there are some opportunities for earlier liquidity is really beneficial. And so I wouldn't want the advice to be only take investors who are going to lock the thing up for 10 years and whatever. I think, but I've kind of like figuring out a healthy balance of long-term partnership and incremental liquidity. Something along those lines feels clearer.
Yeah, that's a great point. I think it part of why, we could look over the last couple of years and say, most of crypto is a ZERP phenomenon, but I think there is this liquidity component to it that really makes it a more compelling place for many of these firms to invest in, and therefore more capital has come into it. And I think,
and it also helps investors justify a little bit more risk taking, because it's not about a full liquidity, but it's more like there are maybe opportunities to de-risk investments a little bit sooner, and I think that can help spur a little bit more risk taking in the early stages, which is good.
Yeah, I think my two bull cases for crypto that I experience somewhat regular are: one, have you ever tried to sell or have you ever tried to do a wire transfer, right? If you have to do a wire transfer, crypto is so much better than that. And the other is, have you ever tried to participate in a secondary share sale? Because those markets are illiquid, challenging, and so unfriendly.
Right.
It's a good way of putting it, for sure. Okay, well, so I say that like the thesis component of USV is another sort of standout in my mind. And you sort of started off this conversation saying we build at the edges, and that is, or exploring the edges, that is sort of the core. But you have very specific theses that have evolved over time. And so I would love to sort of maybe talk about some of those, but maybe more interesting to me is how you as a team come about like theses. How do they emerge and then get codified and published?
Yeah, it's a great question. So the thing that we've been doing for the better part of this year is, and this is the process that you're asking about, is we invest for a while. We think we have an idea of what we're doing, and then every once in a while we kind of pause and try to consolidate our thinking. And that consolidation of thinking is a little bit of what have we been doing, and is there a thread looking back like the last year or two or whatever, and then is that also like a lens for looking ahead? So it's a little bit of looking forward and looking back at the same time. For us, that's the sort of thesis consolidation, thesis development process, and we tend to do that as a team every 5 or so years, give or take. And we've, in the history of USV, published versions of those, over time. The most famous one, I think, if you can call it famous, was a tweet by Brad Burnham in 2011, which described the USV thesis as large networks of engaged users differentiated by user experience and defensible through network effects. So this large networks of engaged users. And that was like, well, I don't know, somehow like this clarifying idea in 2011 that was not just about let's invest at the applications layer of the internet, which was the very first USV thesis, which no one knows about, but was a more specific version of that about a certain style of application that could exist at the application of the internet, which is like networks, social networks, marketplaces, other kinds of networks.
What were some examples of investments there, just to make that?
Yeah, so that first thesis that was published in 2011, but looking back at investments that had been made from 2004, the beginning of the fund, until then. And so the big investments during that time period were Twitter at the Series A, Etsy at the seed under marketplaces, Indeed. I can't remember if it was seed or A. So really looking at like social networks and marketplaces as an example of a style of application that had network effects. And this idea of that, the internet as a platform didn't really exist as a place to coalesce people and, business opportunities in a really scaled way, and that would scale, and that you could build these really large horizontal networks in the early days of, let's call it Web 2, was a filter. And so at that point, there was the filter, the useful filter for USV was, is it a network or is it a tool? And if it's a network, we'll look at it. And if it's a tool, we won't look at it. And the simplest way for us to think about why a thesis is helpful is that, especially with a larger team of investors, you want to be all kind of rowing in the same direction and quickly knowing whether something is in or out. And maybe you're right or maybe you're wrong, but at least you're all kind of doing the same thing. And so that was really an incredibly helpful filter and tool, and still continues to be. When Brad and Fred were first pitching USV in 2003, they wrote a memo describing what they thought the opportunity was at that time. And this was in the ashes of the dot-com, implosion. And the thesis then was a little different. And this one was not one we really published like to the world, but it was essentially, and it's very similar to where crypto is today, was all this money has been invested in internet infrastructure, chips and routers and fiber and all this stuff. And the applications, first wave of them, a lot of them kind of crashed and failed. But boy, all that money went in there, and like the pieces are in place. It's like now possible to like build some apps. And so the first USV investment memo was like, everybody's been focused on chips and routers and fiber, and nobody's thinking about apps. Like, now we're going to think about apps. And again, that doesn't seem like a novel idea in hindsight, but in 2003, it was a novel idea. And so they started out by saying, like, let's only focus on the application layer because the infrastructure is there. And then over the course of the first 5 or 7 years of the firm, got further refined to not just all applications, but applications with some sort of network topology to them, because those seem to be the most defensible, the biggest opportunities. And we can talk about how the thesis has evolved sort of over time since then, but it's always been this sort of, where are we today? What have we been doing and what do we want to be doing? And how do we express that in the simplest way possible?
I think when I've asked you this question, privately, the thing that stood out the most was, I think you phrased it as like this sort of like look back, look forward, like almost like this constant thing. I'm sure is going on in your head. I mean, it goes on in my head all the time. But then somebody just like writes something in the Slack, and it's like, so there's not like this master plan to go create this thesis. It's sort of this like emergent property of the work and thinking you're doing.
Yeah. My partner, Andy, once described USV as a conversation, sort of just like a conversation that's been going on for 20 years. And every once in a while, somebody will say something, write something, tweet something that has like a mimetic quality to it, where you're like, that's the thing. That's the kind of thing that crystallizes all the stuff we've been talking about. And like, there it is, and it's like a moment, and it has this sort of meme quality. Large networks of engaged users had great meme quality in 2011. The biggest meme that ever came out of USV was Fat Protocols, written by Joel Monegro in 2016, which was, a similar thing of, we'd been noticing this inversion about protocols and applications on the internet. And when Bitcoin came along, it was like, it took us a while to realize that Bitcoin was not just internet money, but was a computing protocol. Albert wrote this post in 2013 called Bitcoin as Protocol, which was, again, a consolidation of like several months of us talking. And he put that out there on a blog post and was like, Bitcoin, okay, it's a protocol. And it's part of like the history of computing protocols like TCP, IP, and SMTP and HTTP and so on. That was like a big unlock. And then Joel, years later, not that many years later, a couple years later, we started thinking about, okay, so if protocols now can capture value, that's new. And maybe there's something different about the way that, protocols can capture value versus how applications could capture value. And, then we just talked about that for months. And, Joel's up there on the whiteboard in front of the and in front of the conference room sketching stuff. And there's this diagram in the Fat Protocols post that like shows this sort of inversion of value capture that obviously, and that preceded like tokens, right? So he wrote that in 2016. ICO boom was in 2017. We kind of had this aha moment for us internally that like value capture is going to change. And Joel did an amazing service or disservice. I mean, people have a lot of arguments with that post, but the point was it was a meme, right? It was like a way of crystallizing idea into a tight meme that you could react to. And so we don't always succeed at that, but when it happens, I think it's very powerful.
The most similar moment in my experience was, I think, we use make something people want to be a part of as a defining focus for Seed Club. I think it's trying to get at the social and cultural and mimetic value being the core drivers to token value, or at least as important as the sort of technical drivers behind it. I think that's continued to be a very useful framing for us. But I was sitting in the bath, man. I had a glass of wine. It was a long day, and I just was just reading Y Combinator's post, and I was like, yeah, but it's not quite right. And I tweeted that thing out, and it's by far the thing that resonated the most with our community as a way of sort of defining that. So I love this sort of emergence. And I think when I think about the future of Seed Club, I love this idea of a smaller team because of this sort of maybe where we are in crypto today, but it sounds like even through what you're sharing here across the decades now, just being at the front edge of something is always this process of emergence and participation and exploration. You need to be in the muck to go do it. And I think like where I've seen so many things go wrong for teams in the last little while is they've been trying to professionalize and remove so much of that messiness that I think is absolutely essential to kind of explore these edges so effectively. I don't know where I was going with that, but a thought that came to my brain at least.
Yeah, I mean, I just fully agree. And in spaces that are forming, and the internet is one big version of that. Crypto is a subset of that. Kind of where Seed Club sits is yet another subset of that. And there's others in all different kinds of places. Like what I find happens is like you kind of sense that a thing is happening. You can kind of put a hand on it here and a hand on it there, but you probably have the wrong words for it. And then it looks like one thing, and then a little bit later, it's like almost like archaeology. You kind of uncover it, and then maybe you can get a slightly better word for it, and then eventually, like there's something that clicks. And I know I always give you a hard time because there's sort of a different meme of what is Seed Club, every 6 months, and that I tease you because that it sounds like I'm saying that's a bad thing, but I actually think it's a good thing because this is in a very rapidly changing, unformed area, and the exercise of like trying to put words to it is a big part of it.
Yeah, I think that's my advice to founders: find investors who are happy and excited about being a part of that exploration, right. Or at the very least, being excited that you are in that exploration as a founder, because that's not always the case. I love that you like it's almost like a meme in our conversations now is that specifically. And I think I'm actually very excited to bring you new things because I'm like,
I can't wait to
continue
hear the
prove
new
it.
tagline every 6 months. Yeah.
This has
I
been
look
pretty
forward to it.
consistent. It's been pretty
Yeah.
consistent. So what is the current thesis? And then I want you to tell me why you see C Club fitting into that.
Yeah, great. Well, so, one of the things that we've been thinking about a lot recently is that over the years, the things that we've invested in have gotten broader, right? So if you think about large networks of engaged users, like social networks and marketplaces, roughly, right? Like pretty narrow. And then all of a sudden, we not all of a sudden, but over time, the opportunity set changed and we're in learning with things like Duolingo or in health or in fintech or in crypto. And we came up with different, ideas about why the opportunity was maybe getting more verticalized or more narrow over time, and that sort of adjusted our focus and our thesis. In 2019, we started looking at climate, and we realized that there was a big thing happening there because the world's changing for reasons I think everybody understands, and that was going to like change a whole lot of stuff. And we're like, okay, that there's a chance that climate reshapes society and the economy over the next 20 years the way that the internet has done over the last 20 years, right? Big pressure, big foundational thing. And so we started out by making a handful of energy and climate related investments out of our standard early stage fund that fit right alongside learning and health and other kind of verticals. And then in 2020, we raised a dedicated climate fund. And so then we went through this process of like, okay, well, everybody knows us as this sort of like social networks on the software layer of the internet fund, but now we also have this climate fund. And how do those two things fit together was one question. How do we explain that? Can we explain that? And then secondly, as you get into climate, there's a lot more hard tech. There's a lot more infrastructure. There's, atoms and not just bits. And the question came up of like, is there a USV way of doing climate? Right. And then what do we even mean by is there a USV way of that? We had a sense of it, but we didn't have words for it. And so that all that happening at the same time kicked us into a process to try and explore that. And we spent a lot of the last year doing that together. And that's where we got to this idea of investing at the edge of large markets that are under transformation by societal and technological pressures. And what's interesting about that framing is that it's not a what's going to happen in the next 5 years type of thesis statement. It's a what are the kinds of things that we do thesis statement. It's like more like an umbrella, right? So we really wanted to try to get to the heart of what do we mean by the USV way of approaching investing? Because I think the thesis can serve two purposes. One is what is your style and what is your kind of filter? And then secondly, like what's going to happen in the next 5 years, right? That what are the things you should be getting behind? And those two things are independent but related. And so that's where we've spent the most time recently is trying to look backwards and understand, all right, what is the consistent thing between investing in social networks and investing in vertical networks and investing in crypto and investing in climate? Like, how is it possible that all of those things are kind of like related? Because they seem pretty not related. And we realized that they actually are quite related. And the two big ideas for us are large markets that are under transformative pressures, right? So, something like crypto as an open source technology fundamentally changes the business model of like money and computing in a way that like opens up a huge hole. Something like rapid rising of like global temperature fundamentally changing how we do things like energy and commerce and housing and transportation. And so those are actually consistent in that way. And then the bit about looking at the edges is really important. We never like to go right in the front door of an industry and try and change it by knocking on the door and asking, hey, big industry, can we change you? That doesn't work. All of our success and all of our interest is like, how do you find the little corners around the edges where change is possible and change can be adopted and drawn up, And so if you look at something like crypto changing finance, it's on the edges. It looks like a toy. You don't start by asking the big banks if they'd like to use this, because of course they're going to say no. You start with developers and hackers and indies and use cases on the edges that, where there's a real need. And then in the case of climate, we're looking for places to change these big structural pieces of our economy also at the edges, with just like we've done in education and health. So that's how it's come together for us, is like big transformative pressure, look for that. And then how do you go at the edge of that and look for that? And that's kind of like the USV way in a nutshell. And it's really helpful for us to spend time as a team to try and like synthesize that. And we think that's like has been consistent for 20 or 25 years, will continue to be consistent. And then at each moment in time, like let's call it each 5-year period, the question is like, okay, where is that happening? What kind of opening is being created? With where is the edge of the market that we're looking at that's ripe for the kind of change we like to do? And that's a continual process under the consistent umbrella.
Yeah, I love that. I reached out to you with a very specific topic to get into, and we haven't touched on it once, which is why I love podcasts so much, because I've enjoyed this conversation so far. But I'd love to we have a lot of founders that are clearly building in these edge spaces, and I think like the meme I think that we've really circled around, that I think is as a bundling up of the various, if we think of C Club starting at looking at social tokens or different ways for creators to create, capture, distribute value, and into NFTs, sort of an evolution of that and an explosion that happened over the last couple of years, and then into DAOs, looking at the ways of like, okay, well, if we have these tokens that are emerging, well, there becomes this question of like, where does the long-term viability of these assets come from? And so consumer crypto in our mind was actually a bundling of all those things up, and also a deep belief, as we were talking to founders, of saying like, we have the pieces. Why aren't people like the pieces? We can go build the things. Maybe they're not going to be as good as we can build in the future, but we can go build the things. But the investment community and the broader market is still over-indexing on infrastructure, and it isn't super hot. And I think looking back right now, we're like, well, what an incredible time to go do that. It's clearly where the meta is today. And even as we speak here today, at the end of December in 2023, the meme coin mania has sort of emerged. And I think I've seen this piece that you and Danny Grant wrote all the way back in 2018 really sort of emerge again out of this conversation, which is, I think, the myth of the infrastructure phase, where you both spend a bunch of time really trying to kick kill the idea that there is these two different phases, right? And that really is sort of this evolving dynamic that's happening where apps are driving infrastructure and infrastructure are driving apps. And I think it's a very important thing to maybe resurface today, because I still see a lot of this binary thinking, and I think it skews as builders how we should approach things, thinking about timing, but also the broader conversation. So I'm curious, maybe can you dive in a little bit more into what you actually got out of that? And I think it's probably changed a little bit, so we'd love to talk about that delta today.
Yeah, I mean, I think the basic idea from and in some ways it's a reaction to what we were talking about earlier about the USV, the original USV thesis, right? Was like, there's all this infrastructure, let's go build some apps. And that's right. And on a tight timeline, I think that's true again and again. But the basic idea on the post was, it's not like you can start by going out and building infrastructure on its own. You can, and then expect the apps to come. Oftentimes what happens is that you try to build some apps. The process of building those apps informs the need for some infrastructure. And then that new layer of infrastructure enables a new wave of apps that weren't possible without that infrastructure, and that those apps are going to build on what they have in terms of infrastructure and also help us identify the missing infrastructure. And they tend to internalize it at first and then externalize it. And so there's always this process, and you see it in crypto all like now, just like you did in the internet 20 years ago, of teams building an application that's a combination of building on top of what's possible and like really building a bunch of their own stuff. Internally, like the classic example in the internet is like Amazon, building a bunch of its data centers and then launching AWS, right? Because AWS didn't exist before Amazon had to build it. And then Google and everybody, all the other big Web 2 application companies started with their app, built all the infrastructure needed for that app, and then externalized parts of it. And then other people could build on it. You build up, you internalize what you need to in order to do the next thing you're trying to do. And then some of that gets externalized either by you or by the market. And so it's this kind of ever building stack that gets richer and richer with infrastructure. And so it's not like at any one time, apps aren't possible. It's just a certain type of app is possible earlier on, and a different type of app is possible later. Like, if you look at the internet, in 1994, you could buy a book online, but you couldn't stream a movie online. and like now you can stream a movie online in your living room. And in crypto, like I think of, things like DeFi primitives, like a Uniswap, kind of started out as an application in and of itself, as like a trading application, but is actually like a piece of the infrastructure stack that now lots of people build on in lots of creative and different ways. And so anyway, I guess, and or things like in our portfolio, Helium, a blockchain, blockchain telecom project that we've been involved with since the beginning, launched their own layer one when they launched back in 2019 because you kind of had to then. And nowadays, like no app is really launching their own layer one. Maybe they're launching their own L2 on the OP stack, but the OP stack exists. And in the case of Helium, they, migrated to Solana because, Solana exists, but it didn't in that way in 2019. And so I think it's an interesting phenomenon. I think new applications will always have to invent a part of the next generation of infrastructure, depending on how much they're really pushing the boundaries of what's possible. And at the same time, there are moments where certain classes of apps are like all of a sudden possible. So what's exciting to me about this current moment is that because we have L2s and like better wallet infrastructure and better like bridging infrastructure, you can build social apps on Web3 now in a way that you couldn't a year ago. And so if you take sort of like bridging in the background, cloud wallets like Privy and Magic and Web3 Auth and L2s like Base and Zora and Optimism, like all of a sudden you can build like fun consumer stuff. And like that was impossible to do a while ago. Not just fun consumer stuff that's accessible by like outsiders. So I think that's a really interesting part of the moment that we're at right this second, is that the infrastructure that we happen to have right now enables a broadening of the market in crypto, which is, I think, exceptionally exciting and very relevant to C Club.
Some of the criticism, it seems like you got to that piece. I mean, first of all, I love so much about it because it captures a moment in time, and like so much of it, like the examples in there, historical examples make a ton of sense. But you mentioned a bunch of projects that I don't even think are really doing anything today, which I think is incredible. Yeah. And then I think the other thing that stands out that I just have to comment on is that I think you describe Bitcoin as a meme coin or as an application. The BTC, the token, is an application. So tokens as applications, I think, is actually a really big idea that has thrown through. But it seems like the criticism was like, isn't crypto like both infrastructure and application rolled in one?
Kind of and kind of not. It depends. But of course, the beautiful thing about crypto is that crypto protocols, like a Uniswap or a lending protocol or what have you, are both applications and infrastructure. And the fact that every protocol-oriented application, like a smart contract application, you can think of as an application, it's also an API. So that piece of it, 100% true. That and that's fundamentally one of our most favorite characteristics of crypto, is that every protocol-based application is also a de facto open API, which is not true in Web 2, right? So if that's a criticism, I'll take that criticism all day, because that's also my favorite thing about crypto. And at the same time, there's a class of applications that are, or of infrastructure that are just purely infrastructure. So like cloud wallets would be a good example. You could argue about L2s, like, are they applications? I think probably not really, but they're like, so it's like a little bit of both, but definitely, the fact that some things in Web3 are both at the same time is like the best part about Web3.
Yeah, I agree. I love like how much easier it is to do your customer profile building in Web 2 or the traditional world compared to crypto. You have this sort of, the best users are this sort of blended user. Somebody's an investor, they're an early adopter, likely they're a builder somewhere there as well. And those are maybe the core ones that we focus on, but there's not the daylight between them is actually a lot less than maybe you'd see in a more established industry. And
that's a whole nother interesting idea too, which is that the kind of, what's the difference between an investor and a user in a lot of tokenized environments is a blurry line, and in a good way, right? I mean, to your original point about you big on Twitter but don't own, don't have any attachment to the value creation in the platform. So that's a complicated thing, but also extremely interesting.
Yeah, and I mean, there's a whole other threads to go down. As like, I know the experience you, I think personally, have had in the sort of regulation side of crypto and the different approaches to getting tokens out there. I think there's still, to me, the most interesting things are sort of the mechanism evolution. So as new mechanisms emerge, I think that's really, to me, what Uniswap really brought to the table is like a new long tail of possibilities, truly, with crypto networks. And yeah, it's a fascinating sort of evolution that I think happens there.
Agree.
Well, okay, agree.
Yeah.
I love these conversations because I have 17 different threads I want to go down, and I have like 3 minutes left, so I'm not going to go down any of them right now, other than maybe just to sort of take a step back. You're in this constant sort of state of reformatting and conversation emerging. If we're looking forward in the next, maybe we're coming into a bull market, maybe the bull market is close. What are the things that you've got your eye on today? I know you have other sort of more generalists, but if we maybe just focus in on the market that's maybe most relevant to the listeners of this podcast, which I think are people trying to build in this new application or consumer layer. Like, what are you excited about?
Well, it's the way I've been thinking about it recently is that there seem to be two emerging and kind of parallel tracks of what consumer crypto means. And there's, on the one side, I would call like crypto native, right? And that's sort of meme coins, NFTs, like a lot of the crypto native social stuff, minting, collecting. And there's probably lots of other examples in there, sort of crypto native social community, a lot of communities around tokens or crypto native consumer. And then crypto enabled consumer is happening at the same time. And they're kind of overlapping, but I think rather different. Crypto enabled consumer is like payments, like stablecoin based payments is a thing. Like, we're going to have international, fast, cheap money movement on crypto rails where the people who are using it don't know that it's crypto, but crypto's there and crypto makes it better. And then there's also, you're seeing this in places like loyalty. We're invested in a project called Blackbird that's like crypto enabled loyalty. The crypto's kind of in the back, but not in the front, and lets it, be things that it couldn't otherwise be. I also think we're going to start to see a lot of things that look like marketplace or fintech applications that are actually an on-chain protocol in the back. I met one recently that's doing a ride-sharing protocol, on-chain. I met another one recently that's doing a solar financing protocol on-chain. And these are not really crypto native, right? Like, these are really meant for real people in the real world doing real things. Like, I'm, a driver or rider, or I'm, putting solar panels on my roof. But the fact that you can build that on crypto rails, like, changes the nature of how you build that application. Wow, that's like, all the stuff there is like, was the dream of crypto way back in the day, but it wasn't possible. So that's fucking awesome that those two things are happening. And then the interesting question I'd be curious to get your take on is like, where's the blending between crypto native and crypto enabled, or do you even agree with that framing? And where do you expect the growth to come from?
I truly believe looking at those as two separate buckets is the right way to do it today, because the driving force behind participating in the more native form of this is very different than, I think, the driving force behind that. But I do agree they come together. And I think actually the most interesting example to me right now is actually a blending of hardware product sales and meme coins, which is like the Solana phone and the Bonk airdrop. I think that is absolutely fascinating. This idea, and I think I've also talked to a team recently that's applying a similar idea, that these sort of token people, the belief that tokens have some sort of value, whether we call them points or we call them whatever, I think is actually a meme that has spread and will continue to spread. It's just been hampered by the incredible volatility that exists in so many of these things. And I think, but so seeing that, like, Bonk, the Solana phone sell out because of the pure value of just these Bonk airdrops and perceived value of future airdrops, I think is just like, boom, man, like, that is crazy.
Yeah.
And you can see that being applied to a bunch of other less wildly speculative crypto sort of use cases.
I think that, like, the DPIN space is sort of at this intersection of crypto native and crypto enabled. Like, Hive Mapper has been having a moment recently where, for folks who don't know that project, it's like oh, sorry, my phone is ringing. It's like a decentralized Google Street View, or like a crowd powered Google Street View project where, there's a real powerful incentive driving supply side growth in the form of a token, but also an actual real world utility where the end users of this, the people who buy the photos, probably have no idea that and don't care one bit that there was a crypto incentive that drove it. And so, and there's other examples of that too, but that to me is like a pretty interesting intersection of crypto native and crypto enabled.
It is crazy that into 2023, we've just had an hour-long conversation that didn't touch on AI once. But I think in this context that you're talking about, I'm also seeing some interesting products emerge. And there's a far, far longer conversation to be had around there. And so I know you guys have done a bunch of interesting stuff in that space as well. But yeah, I think that's this sort of attribution and of information, but also of value in these sort of open networks is going to be, I think, a pretty important piece of the tech stack moving forward. We've definitely have some investments in the space around this idea of opening that stack up and the value can kind of flow from it. But I think maybe just to close off, I have the sense of that 2022, 2023 was very much a bear sentiment market for technology. I think we're actually in that right now. There's like a lack of optimism, thank God, not in the world that I hang out with. That's probably the biggest gift that exists in my life, or maybe top 5 at least. But there is this general belief that tech is really fucking everything up and tech bros have fucked everything up. And but there is so many reasons for those of us, I think, that are in this world building to be optimistic about better possibilities emerging as these technologies maybe start to disrupt some of the entrenched pieces in there. And I think it was actually a conversation I had with one of your partners, Brad, who said something like, and I don't just like paraphrasing, something like we tried to defeat the monopolies of the telcos and ended up creating new monopolies. And I'm going to spend the rest of my career here trying to undo those monopolies and create that pursuit towards a more interesting, open, fair internet. So anyways,
that's exactly how Brad thinks, and that thinking is infused into USV, and also is a big part of why we got so interested in crypto so early, because in the most idealized version of crypto protocols, they can be universal, like the TCP/IP protocols, and value capturing. So have these kind of monopolistic characteristics in the sense that they're universal, but not be a monopoly in the sense that they are controlled and captured by a single company who calls all the shots, which of course is what we have, in Web 2 at the stack. And so the idea that you can have universality and value capture, but without, this sort of monopoly problem that we've had in every other type of infrastructure that we've ever built, Web 2 companies, telecoms, everything, is a really exciting idea. It's also why there's so much tension around the value capture in crypto too, and so much love for fair launch projects, that start extremely open and egalitarian and, don't have the same ownership dynamics that, that you'd expect in private companies. And so, but there's a lot of complexity there to kind of get it right. And I think we're, one thing that's also exciting is that, with forking and open source and everything else, like we're getting turns on the wheel on these mechanics. And I think continuing to have chances to try and improve on it and continue to get it right and learn from, each generation of attempts. I wanted to just, briefly touch on your point about whether we should be optimistic or pessimistic about the impact of technology. That's a complicated topic, and it's objectively true that a lot of technology has made the world worse in a lot of ways. And it's also, to me at least, true that the only thing we can do about that is to keep building new stuff that tries to improve on what we had. And so it's a little bit of this conundrum where you have to make new things in order to fix the old things that you broke. And so you have to take the risk that you might break it again in a new way, but you have to try anyway, something like that.
I deeply agree with that, and I think that I would call it sort of a centralist approach, not in that there's a recognition, obviously, of the pluses and minuses or benefits or damages. I think the problem we've had is that there has been just this pure optimism shoved in people's faces without a recognition of the downside. And I think, I mean, that's probably just a product of the internet in its modern source. Like, we see people with EACC and DACC, and I just like, why would you want to categorize you in either of those extremes? It makes zero sense in my mind that is where reality and truth would live. And so, I don't know. I agree. And I think one of the things I really hope that Seed Club can be a catalyst in is really trying to be real and authentic and bring that sort of mentality to this emergent space where we can go do some absolutely crazy, weird things. But there's also been behind a real consideration for their impact and their longevity, and both from like a Seed Club brand perspective, but also from a societal perspective. So I love that.
Me too. Let's go.
All right, Nick. Appreciate your time, man. Lovely conversation. Make sure that we'll drop links to Nick on the internet. He writes a wonderful newsletter and blog, which you kept up on, which I love since back in the day. And of course on Twitter. And appreciate your time.
Thank you, Jess. Great to see you, as always.